Hi, everybody. This is Greg Gossett from Gossett Trading and Mentoring, and today is Saturday, January 3rd, 2026. How you doing? I hope you had a good holiday season, nice Christmas. I hope you had a good trading week last week, and I hope you're having a good weekend at this moment. So this is our first podcast for 2026. I hope it's going to be a good one. And I'll just kind of give you a little bit of an idea of the format for the podcast today. So first of all, we are going to run the U.S. legal disclaimer. Secondly, we're going to come back. We're going to take a look at all the trades that I made last week. We're going to talk about when I entered the trade, why I entered the trade, and how I am going to manage the trade going forward. So we'll look at all the new entries that I have. We'll look at any exits that I had last week, and then the current positions that I have and how I am going to manage them. You know, in trading, it's very important that you're patient, you wait for a proper setup. And for me, a proper setup is a signal or a confluence of signals where you have combinations of different signals happening at the same time. I trade 7 different types of strategies. A lot of the strategies that I use are order blocks, moving averages, RSI levels, divergences, so forth and so on. But when they line up, that's really when, for me at least, I feel the most confident taking my trade and I have the highest win rate. So like I said, we'll take a look at all the trades. We'll take a look at the confluences. We'll talk about how I position size based upon my account size and the volatility of the market. We'll talk about where I place my emergency stop, where I place my end of bar stop, how I go into trailing stop mode, how I take partial profits along the way, and then ultimately how I exit the position. So I hope you're going to find it helpful. If you do find it helpful and value, I really would appreciate if you could hit the thumbs up button. It really helps to build the channel. Just lets YouTube simply know that there's something valuable here and so that they can share it more on their platform. So after we take a look at the positions, we're going to spend a few minutes talk about trader psychology. Trader psychology is the most important skill in trading, being able to control your emotions. You know, having a good trading process or a good trading plan is important. There's no doubt about it. But the important part is the following the plan, good or bad. You can have a great trading system and doesn't mean that every trade is going to be positive, right? And of course, and I have hundreds of losing trades every year. But the point is, I try to keep them small, keep the losses small. And then I have hundreds of winning trades. But, the way that I trade, if I have a winning trade, more than likely, and most of the time, I have a lot more upside potential for my trade than my losing trade. But it all comes down to trader psychology, learning a good plan, which is not that hard, but following the plan, which is the challenge. And so it's always helpful for me to teach trading psychology, and I hope it's helpful for you for this segment. After that, I have gone down through my master watch list. I go down through the list every Friday night, one by one, very carefully, and I'm looking for potential trades for the next week. I'm looking for those confluences that I just discussed. I'm looking for multiple signs of support and multiple key levels. I call them primary entry signals. And I have 12 of them for next week. Now, these charts, they're not where they need to be, but they're within striking distance. So they're within a distance that, okay, they could potentially happen next week. And so I'll go through each one that I'm looking at, and I'll explain why. And then next week, if one of them hits, then I will definitely consider the trade. So I hope you're going to find that helpful as well. So let's go ahead, run the U.S. legal disclaimer, get this out of the way, and then we'll get started. So hang tight, please.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
All right, well, let's get started with the current positions, and we'll start with Shopify. So I entered Shopify back here on the 18th of November at 140.47. So why did I enter this trade? Well, you see this green box here. This is called an order block, and I'll show you in a minute what forms the order block. But when I get a rejection of the high of the order block or a rejection of the low of the order block, that can be an entry signal for me. And that is why I took this trade. It rejected the top of the order block, meaning during the day it went into the order block, but yet it closed back above it. That is called a rejection of the order block. And on this particular trade, that's why I took it. You can also take trades with the rejection of the bottom of the order block, and I have other trades that I'll show you later in the program where that was the case. But this particular case was a rejection of the high of the order block. So let's go back in time when this order block formed, and let me explain a little bit about what an order block is. So an order block, in order to form, these three things need to happen. First of all, we need to have a swing low. And here's your swing low here. A swing low just means that you have a higher low to the left and a higher low to the right, which it does. So that is a swing low. Now, that swing low needs to be followed by a swing high. What is a swing high? It's the opposite. A swing high has a lower high to the left and a lower high to the right. So you can see, here's your swing low, here's your swing high. The next thing we need is we need another swing low that's lower than the first swing low. And here's another swing low that has a higher low to the left and a higher low to the right. So here we go. We have a swing low, we have a swing high, we have a lower swing low. Now, the last piece of the puzzle in order for an order block to form is that in the future now, that first swing high, remember the first swing high right here, it needs to be taken out, or in other words, the price needs to go above it. Well, that happened here. As soon as this happens, as soon as this first swing high is taken out, now the order block forms. And the order block is simply the lowest closing bar prior to market structure change. So let's look at it one more time. We have a swing low, we have a swing high, we have a lower swing low, and then price goes through the top of that first swing high. Right here on this bar, we have changed market structure to the upside, and therefore the lowest closing bar prior to the market structure change is the order block. And this is the high and the low of this bar. That is the green box that I moved into the future. So let's go up here when we're up here at 169.49, or we go up here to 181.63. Looking back in time, when the prices are here and they're here, if we look back to this order block, can we conclude that smart money was buying here? Yeah, clearly smart money was buying here. In hindsight, it's obvious in 2020, right? When you're up here at 181 and you look in the past and you see this order block, you can say, yeah, obviously, looking back in hindsight, with 2020 vision, smart money was buying here. So the way that I look at order blocks is I know smart money was buying here at some point, especially when the market was up here. Does that mean in the future, if we come back to this area, will it be smart money again? And the answer is sometimes it is, sometimes it isn't. But in my experience and over 30 years of trading, it is smart money more times than it is not smart money. And therefore, that is the edge. So swing low, swing high, lower swing low, market structure change defines the smart money area, bring the smart money area into the future. And if in the future it gets back to that smart money area, that's the place that I want to potentially take my trade. Now, I didn't buy this here, but look, swing low, swing high, lower swing low, market structure change, it pulled back. Where did it stop? Right at the smart money area before it took off again. I didn't take this trade. Okay, so I've defined the order block. I've moved it into the future. And all I'm waiting for is the price to get back to that smart money area and reject the high or the low or a major moving average inside the order block if that happens. And I'll show you examples. So let's just move forward. Okay, I've defined the high and the low of the order block, and then we came back. And what happened? We came back right to the smart money area. Okay, this is why I took the trade. So you can see it rejected the high of the order block. I took the trade at 140.47. Okay, so I see my entry. I see the signal. It's legit. Now what do I need to do? Obviously, I need to decide how many shares I'm going to buy. And so I have a very simple formula that I use, and I'll explain that to you right now. It consists of two things. One, how much is in your trading account, dollars, and what is the value of the 2 ATR. An ATR is average true range, what a bar is expected to move based upon the last 20 days. So I take that value times 2, and this is how I do my position sizing. When the average ranges are large, that means the volatility is higher. If the volatility is higher, the formula that I'm going to show you, you're going to buy fewer shares. If it's low, you're going to buy more shares. So therefore, in a volatile environment, this formula using the values of the 2 ATR are, like I said, are going to just by default have you buy fewer shares. And that's correct. When volatility is higher, you should buy fewer shares. When volatility is lower, you should buy more shares. All right. So first thing, how much do I have in my trading account? Let's just say I have $100,000 in my trading account. All I do, simply take 1% of that. 1% of 100,000 is $1,000. Now I take that $1,000 and I divide it by the value of the 2 ATR. Right here it's saying 1183. This changes every day, by the way. $1,000 divided by 1183 tells me to buy 84 and a half shares. Okay, I'll just round it up to 85 shares. So now this formula, based upon how much I have in the account, which is important, and what the volatility of the market is, I know, okay, for me, this is the perfect amount of shares to buy, 85 shares. Okay, so I have the entry, the rejection of the high of the order block. I buy 85 shares. Next thing I do, I go back to the 2 ATR value and I just subtract that from my entry price. So here's my entry price, 147. I subtract the 2 ATR and I put the emergency stop down here. Now we just did the math, right? 1% of $100,000 divided by the value of the 2 ATR, 85 shares. If I have 85 shares and it moves down $11.83, how much have I lost? I've lost $1,000 because we did the math, right? So this is my emergency stop. If I hit my emergency stop, I am going to lose 1% of my trading account, right? We just did the math. Now, the good news, well, I should say, if you lose 1% of your account, okay, it's not fun. It's not the end of the world, but you can recover from that. But the good news is that the emergency stop only hits about 5% of the time. The other 95% of the time, if I have a loss, it's not going to be because it hit my emergency stop. It's going to be because it closed below my end of bar stop. I always have two stops, emergency stop, end of bar stop. And the way that I structure these trades is the end of bar stop is always going to be closer to my entry point than the emergency stop, always. So if I have a loss, it's going to be, a large percentage of the time, it's going to be much less than 1%. Okay, but the worst case is 1%. The second worst case, if you have a loss, it's going to be a loss, but it's going to be less than 1%. Okay, make sure. And I have a trade that hit my emergency stop this week that I'll show you in just a little while when we get there. So it does happen, just not very often. Okay, now my end of bar stop on a order block is just a close below the low of the order block, right? I have the emergency stop down here, 2 ATRs below, but my end of bar stop on this trade is just a close below the low of the order block, which is 133 42. But you can see 133.42 is much closer to my entry price than my end of bar stop, which is down at 126.60. Okay, now the next thing I do is I look for the value of the 1.5 ATR. The value of the 1.5 ATR at the moment is 887. So what I do as soon as I enter my trade, I place my emergency stop 2 ATRs below. My end of bar stop is on this particular trade to close below the low order block. I look for the 1.5 ATR value. Right here it's 187, and I add that to my entry price. So in other words, I take my entry price plus the value of the 1.5 and I place it above. And this is the orange line. This is my trailing stop level, which is 1.5 ATRs above my entry. Okay, and a trailing stop level, all this means is that if I get to trailing stop level, now I go into trailing stop mode. Doesn't mean I do anything, it just means I'm in trailing stop mode, which means once I get to trailing stop mode, and then in the future I have a close below a previous bar's low, now I'm going to take off half the remaining shares that I have. So in trading, if you enter a trade and it moves nicely in your direction a certain amount, for me it's 1.5 ATRs, well, now you have a nice trade. You don't want to give all of that trade back. So that's why I go into trailing stop mode. So if I get to 1.5 ATRs, and then in the future I have a close below previous bar's low, that has the effect of tightening up my stops. If I sell half my position, that has the effect of moving everything up, which is moving up your stops. And that's what you're supposed to do in trading. If you get to a good place, and you don't want to give it all back, you have to move your stops up. Well, selling half does that. All right. So let's just kind of take another look at it. We had a rejection of the high of the order block. I entered at 140.47. I position sized. I placed my emergency stock 2 ATRs below. My end of bar stop is a close below the order block. And then I placed my 1.5 ATR trailing stop level above. Now, everything that I've talked about so far, as far as the emergency stop, the end of bar stop, going into trailing stop mode, and then getting out of half if you have a close below a previous bar's low. These are all defensive moves. In other words, okay, the market went against me in some kind of fashion. I have to take action defensively. But I also like to play offense in my trading, not just defense. And so how do I do that? It's very simple, really, and I'll show you exactly how I do this. So I do this every single day. I have to do it every single day for the next day, but it's very simple. All I do is I take the closing price of the day. Right now, Shopify, I'm still in Shopify. The closing price is 157.20. So 157.20. And now I look for the value of the 0.45 ATR. Okay. The value right now is $2.66. So I take my closing price, 157.20, plus 266. My first profit target for Monday is 159.86. So Monday, if it gets to 159.86, I will place a limit order in there to sell 10% of however many shares I went into with the day. If I have 30 shares going into that day and it hits the first profit target, I just take 10% off. I take 3 shares off. That's simple, right? But I do it 3 times. I place 3 profit targets. So the first profit target is 157 plus 266, which is 159.86. I place an order for Monday telling my platform, okay, like I said, if I had 30 shares, please sell 3 shares at 159.86 limit. Fine. Now I do it again. But I start with my first profit target, 159.86, and I add the value of the 0.45 to it again, plus 266. My second profit target for the day, 162.52. And again, I will place another limit order there for another 3 shares, or another 10% of however many shares I went into the day with. And then I do it one more time. I want to place the third, so I take the second, 162.52 plus 266. And my third profit target for the day is 165.18. Now, if Shopify just continues down on Monday, I'm not going to hit any profit targets, and I'll have to redo it for Tuesday. But if it moves up decently, maybe I hit one, I take a little off. But the key with profit targets, everyone, is I always believe in my trading that if the market gives me something, I want to take a little something. Not all, just a partial. But over all the years that I've traded, taking these partial profits off is hugely important because one, you take off some of your profit, you lock in that profit, market can't take it away from you. Now your position size is lower, and the lower your position size gets, the easier it is to stay with your process, right? It's just a fact. So now if it went up big, 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 I would hit 3 profit targets. That's fine. I sell into that strength. If it goes down, I don't hit any profit targets. So the emergency stops, the end of bar stops, the trailing stop mode, defensive, selling partial ATR profits or taking partial profits every day if it moves at least 0.45 ATRs from the previous bar's close. That's the offensive nature of my trading, selling into strength. All right. Okay. So now that I've kind of given you the basics of the setups and the emergency stops, the end of bar stops, trailing stop modes, let's just go through the trade, right? And let's just see how I managed it. So again, I entered on November 18th at 140.47. Why? Rejection of the high of the order block. I position sized by taking 1% of my total trading account, dividing it by the value of the 2 ATR. That shows me how many shares to buy. I then place my emergency stop, exactly the value of 2 ATRs below my entry. My end of bar stop is a close below the low of the order block. I take my entry price plus 1.5 ATRs above. That is my trailing stop level. And keep in mind, I'm taking partial profits every day if it moves at least the value of 0.45 ATRs. So I enter 140.47. The next day goes up. Great. Good start to the trade. I hit 1 profit target. Perfect. Next day, gaps way up. I hit multiple profit targets. I can't remember if I hit 2 here or 3 here because it was so long ago, but it's certainly at least 2. And I sold right there at the open, and I got to trailing stop mode. Doesn't mean I do anything. It just means now in the future, if I have a close below a previous bar's low, I'm going to get out of half. The next day down, no profit target. Oh, no, excuse me. There was a profit target there because it closed lower. We move up again, profit target, move up, no profit targets, no profit targets. Here on the first was our first close below a previous bar's low after reaching trailing stop level. What do? I take off half the remaining shares that I have, which I did, and I locked in a profit of 5.72% on the shares that I sold. And we continue up. And I'll, just take you through this. This was a profit target, no profit target. We kind of went down into this big strength, certainly a profit target. Then we moved down, profit target at the open, down. And you can see as we moved up here, had some profit targets. And then on Friday, we were down quite a bit. So when I enter a trade and I get to a 65 RSI level, right now you can see the RSI is 4286. If I get to 65 or higher, then the 5 EMA, which is this little blue line here, comes into play. And I'll show you, not on this particular trade, but on MasterCard. If I get to a 65 or higher and then it closes below the 5 EMA, that's when I exit the trade. I also have rules about when you get up to the 70 RSI, what to do there, but I don't have any of the 70 at the time, so I'll show you the ones that are most relevant. But anyway, the remaining shares that I have on Shopify, doing pretty good, up 10.59%. And again, just to point out on these partial profits, I hit partial profits up here and up here. Am I glad that I sold partial profits and got near the top? Yeah, of course I am. So going forward with this trade, with the shares that I have remaining, if it continues to go up, of course, I'm going to take partial profits into that. If it gets to the 65 RSI level, then the 5 EMA will come into play. If it heads down, what am I going to do? Well, I'm just going to hold in there, and I would get out if we close below the low of the order block. But anyway, this particular trade with the rejection of the order block, doing pretty well. The remaining shares up 10.59%. All right, here's Altria, symbol MO. Well, this is an order block from the past. I took this trade on this one with the rejection of the bottom of the order block. You can see we were below the order block and then we closed back in it. So I took the trade here on the 3rd of November at 55.60. I position sized. I placed my emergency stop 2 ATRs below. My end of bar stop is simply a close below this order block. You see how close I am to that order block to begin with? Well, that's perfect, because if the next day it closed even a penny below the low of the order block, I would get out with a very small loss. And this is really what trading is about. It's about entering the trade with a good risk to reward ratio. Or another way to explain that is a good risk to reward ratio just means how close is your stop compared to your entry. If it's very close to your entry, then you have a good risk to reward ratio, meaning if it goes down, you can be wrong small. If it goes up, well, theoretically, you have a long ways to go up for potential uh, potential profit. So just a good risk to reward ratio. Okay, so it rejected the bottom of the order block, got in at 55.60, placed my emergency stop 2 ATRs below. My end of bar stop is simply a close below the order block. I placed my 1.5 ATR trailing stop level above, as always, and the next day we go up. Not enough for a profit target, but it's up. Next day we go up a little bit more, have a profit target. Great, took a little profit. Then we go sideways, up a little. Can't remember if we have a profit target there, sideways. Here, certainly the next day on the 11th, it moved up enough for a profit target and it got to my trailing stop level. Doesn't mean I do anything. It just means now I'm in trailing stop mode. Next day down a little. Next day, first close below a previous bar's low after reaching trailing stop level. What do? I sell half of my position and I locked in a gain of 2.06%. Now, going from here, anytime it moves up the least the value of the 0.45, it took a profit target. So I took a profit target here. Then we went down, but we didn't close below my end of our stop. So I stayed in the trade. Next bar here, profit target. Then we kind of inched our way up, really not enough for a profit target. Then we inched our way down, and then we rolled back up, did hit a profit target here, did hit a profit target here. So I was selling anytime we had, any kind of larger move up, I sold into that. And basically this trade ever since has just basically gone sideways, right? Which is fine. It pays a dividend, so I'm glad. So the remaining shares that we have on MO, up 3.05% plus the dividend. So not bad, but it all started with rejection of the bottom of the order block with a very good risk to reward ratio. USO, which is oil. All right, this was also a rejection of the high of the order block. The order block was created in the past. I entered the trade here on the 20th of October at $67.81 because it came into the previous order block or smart money area, closed back above it, got in 60.81. Position size, place my emergency stop 2 ATRs below. My end of bar stop is simply a close below the order block at 66.30. I place my 1.5 ATR trailing stop level above. Next day took off, right out of the get-go, moved my way, hit a profit target, great. Next day up big, hit multiple profit targets, also got to trailing stop level. Next day up again, big massive gap up where I think I hit 3 profit targets on this day up. So you can see I sold a very substantial amount into this strength, which in hindsight, I'm very glad that I did. Okay. Okay, we're in trailing stop mode, and now here we have our first close below a previous bar's low after reaching trailing stop level. I sold half of the position, locked in a gain of 4.97%. And then we've kind of been moving sideways. So I just stayed with the trade. Anytime there was any, substantially larger up bar, I would take a profit target like on this day, on this day, on this day. And then look at this. We had this move all the way back. This bar kept me in the trade. Why? Look, it went under the low of the order block, but at the close, it closed back in. That kept me in. Had it closed below, I would have had to get out, right? But then the next day, big move up, multiple profit targets, couple days of sideways motion, then a big move up here, where again, I took profits into that move. And from here, we've just kind of gone down and up, really not enough for a profit target. So the remaining shares left on this particular trade on USO up 1.7, which is okay, it's fine. But if you look back here on this big move up, can you see the value with me taking the profits into the big moves? Because I sold some up here at 73, where right now it's only 69. So it's just a good example of why taking the partial profits, in my experience, in my opinion, is really a beneficial thing to do in your trading. But the remaining shares on USO up 1.7%. FXY, another order block that I took. FXY is the Japanese yen. I bought the Japanese yen here on 11.20 at 58.33. Why? Rejection again at the bottom of the order block. Position size, place my emergency stop 2 ATRs below. My end of bar stop is simply a close below the low of the order block, which we're so close to anyway to begin the trade at 58.23. I placed my 1.5 ATR trailing stop level above. The next day, boom, right off the bat, continues my way. I hit multiple profit targets and I am in trailing stop mode already. Next day goes down but closes above the previous bar's close. Next day up, profit target, took a little profit into that move up. And then here on the 26th, we have our first close below a previous bar's low after reaching trailing stop level. What do? I take off half of the position and I lock in a gain of 0.78%. Next day is up. Next day's up large. It's up big. I hit multiple profit targets into that strength. Then we head back down and then we move up again. Again, profit targets here. Then we have 4 days down, so nothing happens there. The next day up, profit target. Next day up, profit target, and then down. And then we move up again where I have some profit targets. Then the FXY takes a big move to the downside, but still keeps me in the trade because it does not close below the low of the order block. And then the next day's up a profit target, and then another profit target here, and then we've kind of moved sideways. So I'm still in the trade. The remaining shares that I have up 0.46%. But again, was it a good idea for me to take profits at these much higher levels when the market gave them to me? Absolutely yes, right? Okay, let's go on to the next one, UNH. Okay, UNH been a good trade. I got into that here on the 22nd of December at 324.90. Okay, why did I get in? Order block. Well, let's take a look at what makes the order block. Here's a swing low. Here's a swing high. Here is another swing low that's lower than the first swing low. And then this bar here on the 12th takes out that first swing high. This changes market structure to upside. And remember, my order block is right here on the 10th, the high and the low, this order block, moving it into the future. Now, so far we have talked about rejections of the high of the order block and rejections of the low of the order block as far as entries. And they're totally legit. But how do I take a trade inside the order block? Can you do that? The answer is 100% yes, as long as you have a key level inside of the order block. Now, a key level could be a moving average, like this red line here is the 100-day moving average. You could have keyed off of this for your end of bar stop. But what I keyed off of, I made my own level here at 324. And why did I pick this level? Well, look at the bar here, the big up bar. So when you have large up bars, big, strong up bars, halfway of that big up bar there's going to be some inherent Fibonacci support at 50%. So basically the midpoint of the bottom of this bar and the top of this bar. It has to be an up bar, okay? So I picked the level here at 324. halfway of this big up bar, and I move that level into the future. Now I have a key level inside the order block. Okay, the best trades come when you have key levels within key levels. The larger key level is the order block or the smart money area. The other key level is the level that I defined here at the halfway at 324. So we change market structure to the upside. We come back to the smart money area, the order block. And then on this day, on the 22nd of December, I entered at 324.90. Why? Because we rejected this level that I put in here at 324 that I knew had a better chance than not that if this level was rejected, that would be bullish. And this is exactly what happened. You can see during the day, we went below my key point at 324 and then closed back above it. So I entered 324.90. I placed my emergency stop, or I position size, as I mentioned before. I placed my emergency stop 2 ATRs below, as always. And now my end of bar stop, it's not the bottom of the order block because that's not where I based the trade off of. I keyed it off of this 324 level. So my end of bar stop in the future is simply if it closes below 324. And you can see how close I am to that level anyway. So therefore I have a good risk to reward ratio. Okay. Okay, so after I know where my end of bar or my emergency stop is, I know where my end of bar stop is, which is the 324 level. I place my 1.5 ATR trailing stop level above, and away we go. So next day, it's down slightly, right? It's down slightly. I'm just about break even, but the key is it stayed above my key level at 324, the midpoint. So it stayed in the trade. The next day goes up. Was able to hit a profit target, take a little off. Next day, went up again, able to hit another profit target, selling into that strength. Next day, down a little. Next day, up. At the high of the bar there, I definitely hit a profit target. Next day, down a little. And then Friday, up nicely. I hit 2 profit targets. And so I took 2 profit targets into that strength. And now I got to trailing stop level. Doesn't mean I do anything. It just means now in the future, if I have a close below a previous bar's low, I would exit half. So anyway, this trade's worked out very nicely. And the remaining shares I have on UNH up 3.4%. But again, the key takeaway here is that I have the order block, but I have a key level within the order block. And again, key levels within key levels, you're going to have more success with that than just one level, right? So a key level, the midpoint of the up bar on the 10th, that resides and lives inside the key level of the order block. So up 3.4% remaining shares. Okay, Microsoft. Microsoft, again, is an order block from the past. I entered here on the 21st of November. Why? Because we rejected the bottom of the order block, meaning we went below the order block during the day, but it was strong enough to close back in the order block. So I entered here 11/20 at $472.10. Position size, place my emergency stop 2 ATRs below. My end of bar stop is simply a close below the low of the order block, the keyword being close. Place my 1.5 ATR trailing stop level above. Next day, during the day, it was below my order block, but it didn't close below the order block. That's what kept me in the trade. The next day again, there was price discovery below the order block. Had it closed there, I would have to get out, but it was strong enough to close in the order block, kept me in the trade. Next day, we move up where I hit a profit target. Next day, move up again where I hit a profit target. And on this particular day, I'm also in trailing stop mode. Then we go down a little the next day, up a little the next day. At the high, I took a profit target. And then the next day, we have our first close below a previous bar's low after reaching trailing stop level. What do? I took off half the position for a gain of 1.33%. Okay, then we creep up a little, again. We have a nice big up bar here where I'm able to sell some partial profits into that. And then we moved down, but it never closed below the low of the order block, which kept me in the trade. Next day, down a little. Then we have a nice big up bar where I'm able to take partial profits into that again. And then for over a week, it just moved sideways. Nothing. No profit targets, nothing, right? And then Friday, yesterday, big down move. Really big down move. But did it take me out of the trade? No, it didn't. During the day, it was below the low of the order block, but again, it closed back in the order block. So the remaining shares only up 0.17%, but I'm still in the trade because my rules told me not to get out because it didn't close below here. But again, this is a good example, everyone. Am I glad, in hindsight, am I glad I took partial profits into the strength when it was up in these areas? Yeah, of course. I'm up a lot more on the trade than 0.17% because I did that. And so that's why I'm such a big fan of taking partial profits. So, but the remaining shares still in the trade up 0.17%. If Monday it closes below the order block, that will be my signal to exit the trade. AMD. Okay, AMD's been a really nice trade. Again, order block trade. I entered here on the 18th of December at 201.10. Let's revisit why. Okay, we have a swing low here. We have a swing high here. We have a lower swing low here. Here, we go above that first swing high. That changes the market structure to upside, and it defines the order block, right? So I define the order block, the high and the low of the order block. I bring it into the future. Now, when it comes down, I'm looking for either a rejection of the high of the order block, the low of the order block, or some kind of level inside the order block. Well, I took the trade here on the 18th when we closed back above the moving average, the red line. You can see the day before we closed below the red line. But the next day, we closed above the red line. So it was a rejection of the 100-day moving average key level, key price action that happened within the order block, key level within the key level, right? So I entered here 201.10 with a close back over the 100-day moving average inside the order block. I position size, I place my emergency stop 2 ATRs below, and my end bar stop, always want to have that close, right? That simply would have been a close below the red line. It's simply a close below the 100-day moving average. That 100-day moving average is my line in the sand. Underneath it, I'm out. Above it, I stay in, okay? So I place my emergency stop 1.5 ATRs above, and away we go. The next day, fortunately, market took right off after that signal. I sold multiple profit targets into that strength and also got to trailing stop level the very next day. Now I'm in trailing stop level. The next day, gaps open, was able to take another profit target there. And then we kind of just moved sideways for a week, did nothing until Wednesday, where we had our first close below a previous bar's low after reaching trailing stop level. What do my rules tell me to do? My rules tell me to take off half, which I did for a gain of 6%. But I remember, I still have half. And then Friday was up 4.3%. And I hit 3 profit targets into that strength. Now you might say, well, you're probably mad that you sold half. No, I'm not. Really. The thing about selling half, everybody, it's the only win-win situation in trading. If you sell half and it goes down, you are glad that you sold half higher. If you sell half and it goes up, that's why I only sold half, right? So I'm glad that at least I had that other half that I was able to hold and take into that strength. So the remaining shares on AMD, yeah, up 10.02%. And again, how did the trade start? Identifying the order block, looking for rejection of a key level in an order block, key level within key level. And so, yeah, great trade. up 10.02%. TLT. Okay, so TLT, I got into TLT here on the 26th of December at 87.73. Why? Now, I got into this based upon what is called a bullish abandoned baby. And when I trade abandoned babies, I have a little different setup. I don't take the partial profits. This one is kind of a set it and forget it trade where I enter, I place a stop, my 2 ATR stop as always, 2 ATRs below my entry, and I place a 4 ATR profit target above me. So again, in this one, I'm not taking partial profits. I'm either going to lose 2 ATRs or I'm going to make 2 ATRs. It's very simple. Like I said, you set it and forget it. But let's talk about what a abandoned baby is. An abandoned baby, the abandoned baby is here on the 23rd. You can see I highlighted it in green. The reason it's called an abandoned baby is the previous day it opened higher and gapped down. You see this gap down. Okay, it gapped down. So overnight, the sentiment was very bearish for whatever reason, gapped down. But the very next day, it gapped up. And when you have a gap down and the very next day you have a gap up, it's a very quick and sudden dynamic change in sentiment from bearish, gap down, to bullish. Now, why is this important? When this happens, more times than not in the future, you are going to see prices higher, about 70% of the time. 30% of the time, they're going to go lower. So, from my perspective, if I know when I have an abandoned baby that 70% of the time things are going to be higher, well, I want to capitalize on that. And so I entered here at 87.73 when the price came back down and tested the high of the order block. So that's why I entered at 87.73. I placed my profit target 4 ATRs above. I placed my stop loss 2 ATRs below. So one of two, and I just put a limit order, one cancels another to say sell up here basically at $90 or sell down here at 86.46. If I'm wrong, I'll lose 1%. If I'm right, I'll make 2%, right? But being that there is a bias in my in my experience of a 70%, when you have a bullish abandoned baby, 70% of the time I'm likely to see it higher. That's the right move. If I'm right, I'm going to make twice as much as if I'm wrong. Now, this trade is underwater. It has not yet hit my 2 ATR stop, and if it does, okay, this was one of the 30% of the times where it didn't work. But if you've been watching this podcast for years, you will see the majority of my bullish trades or my bullish babies, abandoned babies, are higher in the future and lower. And so this one is lower at the moment. I mean, it could turn back up. I could still hit my 4 ATR profit target, but I'm down 0.8% on the trade. So not down that much percentage-wise, but we'll see. You know, if it comes down here and hits my stop, I'm just out of the trade. I was wrong, and that's it. But I will stay into this until either 86.46 is hit to the downside or 90 is hit to the upside. And eventually one of these two will be hit, right? So down 0.8% on this particular trade. Okay, UNG, this is a trade that I took on Friday, just barely entered the trade. So why did I enter this trade? Well, we have a new order block that was formed. Let's take a look. Here on the 16th, we had a swing low, followed by a swing high, followed by a lower swing low. This bar here took out that first swing high. That changes market structure to the upside. Once market structure has changed to the upside, I want to look to buy dips. Well, that's exactly what I did. So we changed market structure to the upside, then we pulled back. And why did I enter it here on Friday? Because we rejected the high of the order block. We went in the order block, but then closed back above it. So I got in at 12.07. I position sized. I placed my emergency stop 2 ATRs below My end of bar stop is a close below the low of the order block, or the low of the green box, at, what is that level? 1148. And then I placed my 1.5 ATR trailing stop level above. So I just barely entered this trade, basically exactly break even. So going forward, Monday, if it closes below the order block, what do? I get out. If it goes down but stays above the high of the order block, what do? Nothing. I'm still in the trade. If it moves up on Monday, look, the value of the 0.45 is 33 cents. So 1206 plus 33, that's going to be my first profit target, and I'm going to place 3 profit targets. So if it moves up at least 33 cents on Monday, I will at least take 10% of however many shares I have going into the day off. And then if it gets up to trailing stop level, then I'm in trailing stop mode, right? Getting to trailing stop mode is a really great thing because you're definitely in the profit. So this is a brand new trade, but I thought it was a good one to show to you because we had a new order block that formed and it rejected the high of the order block, and that's why I took the trade. So we'll see what happens with UNG. Okay, so those are all of the open trades that I have. Let's take a look at the closed trades that I had. So closed trades either because I got stopped out or because I exited the position. So I was telling you that emergency stops only happen about 5% of the time, but they do happen, and I did. I haven't hit an emergency stop for a while, but it did happen to me, and so I want to show this to you. So I really like this trade. It just didn't work out. So I've talked about bullish order blocks in the green. Well, there is such thing as bearish order blocks as well. And a bearish order block is the opposite. You have a swing high. You have to start with a swing high, followed by a swing low, followed by a higher swing high, and then you have to take out the swing low to the bottom. When that happens, you change market structure to the downside. And you can see when that market structure changed here, did it go down? Yes, it certainly did go down. Now, I didn't take this trade, but the key is on a bearish order block, a bearish order block, you want to look for the highest up bar close before market structure change to the downside and take that area into the future. And you can see when we got back up into that area that first time, it just collapsed. So that's what I was looking for. On this particular trade, I was looking for a rejection of the bottom of the order block, or the bottom of that bearish abandoned baby. A bearish abandoned baby gaps up, followed by a gap down. You can see it nailed that one. But I took the trade here on 1230 at $218.52. Why? Because it rejected the bottom of the order block. Now, my end of bar stop is a close above 222.50, which is the bottom of the bearish order block. There's going to be a lot of resistance there. So that was my entry point, or my end of bar stop. But again, I always place an emergency stop, whether I'm long or short, 2 ATRs above. Well, I was short on this trade here at 218.52. So I placed my emergency stop 2 ATRs above, and look what happened on Friday. Started off down and then huge rally up, and I had to get out at the emergency stop. Only happens 5% of the time, but it did happen. So on this particular trade, I lost 1% of my trading account because I did the math before, right? My emergency stop, if I get to my emergency stop, I'm going to lose 1%. It's exactly what happened. So I lost 3.82%. Again, it doesn't happen very often, but it does happen. And that's why you have to have these emergency stops in place. So on this particular trade, I did lose 3.82%. And then the last trade, I did exit MasterCard on the 31st. And let's first talk about why I got into the trade. Well, it was an order block trade that I entered here on the 19th of November. Why? Because it rejected the bottom of the order block. So I entered at 530.38. I position sized. I placed my emergency stop 2 ATRs below, as always. My end of bar stop, simply a close below the low of the order block. You can see after I entered at 530.38, next day it went up, where I did did hit a profit target, which was nice, but then it reversed dramatically. But do you see how it kept me in the trade? Had it closed below the order block, I would have gotten out, but it kept me in the trade, thankfully, because it didn't close below the low of the order block. The next day, takes off big, multiple profit targets. Next day, nothing. Next day, up again, nice. I sold partial profits into that. Also got into trailing stop mode, so I hit my trailing stop mode level. And then next couple days, it doesn't really do much. And then here on the 1st of December was our first close below a previous bar's low. After reaching trailing stop level, what do? I took off half of the position, locked in a gain of 2.51%, but I still have half. Next day up, profit target. Next day up, profit target. Then we moved down for about 4 days. And then here on the 11th, we had a huge move up where, of course, I hit multiple profit targets into that strength. The next day, up again, profit target into that strength. Then we kind of moved sideways for about 4 days. And then up in this region here, we got to 65 RSI level. And like I mentioned earlier in the program, if I get to 65 or higher, and then I have a close below the 5 EMA, I exit the entire trade. And that's what I did on the 31st. We had our first close below the 5 EMA. Prior we were at a 65 RSI level. And so that is why I exited the trade. And I locked in a gain of 7.5% on the remaining shares. So there you go. Those are the positions. The last two are the positions that I closed. One with the emergency stop, two with close below the 5 EMA, and then the prior ones that I started with. Those are the open positions, and I'm still in those. So all in all, pretty good. Happy with the results. And I also trade weekly charts, and because the ones I just showed you were daily. So let's go to the one weekly trade that I have, and I'm still in this trade. This is UUP. This is the US dollar. Now, each bar on a weekly chart is a week, right? Every bar you see here is a week's worth of business. So I entered UUP on the weeklies here back on 7/11 of 25. Why? Okay, I always talk about confluences, looking for more than one thing happening. Well, on this particular week, the prior weeks we went into the bullish order block, but then we closed above the order block. Closing above the order block is a rejection of the high of the order block, so that's one signal. That's a primary signal. In addition to that, we have the 200-week moving average, which is the black line inside of the order block. Remember, key level within key level, 200-week moving average by itself is a key level, and then inside the order block is a key level. So the previous week, we closed below the 200-week moving average. Then the next week, we closed above it. So we had two things that happened. We had a close under and close over the 200-week moving average, which by itself is a legitimate signal. And then we had a rejection of the high of the order block, which is a rejection, which is, again, a legitimate signal. So that's the confluence. Rejection of the 200-day moving average, or 200-week moving average, and a rejection of the high of the order block. So that's why I took the trade at 26.31. Got long, 26.31. I placed my position size. I placed my emergency stop 2 ATRs below as always. And my end of bar stop on this particular trade is simply a close below the 200-week moving average. Oh, sorry, the dividends came in here, messed up my, okay, there we go. So yeah, my end of week stop is a close below the 200-week moving average. Okay, so we have a rejection of the 200-week moving average. We have a rejection of the high of the order block. I get in at 26.31. I position size. I place my emergency stop 2 ATRs below. My end of bar stops are closed below the 200-week moving average. I place my 1.5 ATR trailing stop level above, and away we go. The next week went up enough for me to hit a profit target. Great. Next week came down During the week, it went below the 200-week moving average. Had it closed there, I've just gotten out of the trade, but it recovered, closed above, kept me in the trade. The next week, up big. Multiple profit targets, also got to trailing stop level. Next week, down. Next week, we have our first close below a previous bar's low after reaching trailing stop level. What do? I took off half of the shares because it closed below a previous bar's low after reaching trailing stop level, locked in a gain of 0.49%. Then we moved sideways for about a month. This particular bar here on the 19th of September, during the week, we were way below the 200. I thought, well, I'm going to have to get out of this trade. But miraculously, it recovered, closed above the 200 week, which kept me in the trade, right? Next week, up, sold some profit target into that strength. Next week, nothing. Next week, up again, sold into that strength. 2 weeks sideways, nothing. Next week, up, sold into that strength. And then here on this particular week, sold into that strength. And then we've moved down and we were up a little bit here. So we haven't got to 65 RSI. So the 5 EMA does not come into effect. So going forward, if it continues to move up, I will continue to take profits. If it gets to a 65 RSI level, then the 5 EMA will come into play. If it goes down and closes below the 200, that's the end of the trade. So the remaining shares on this trade doing pretty well for a currency, up 2.95%. So there you go. Those are the daily and the weekly trades that I'm in, and hopefully that was helpful for you to get an idea of why I entered the trade and how I am managing the trade going forward. So before we get to next week's potential trades, let's spend a little time on trading psychology. I think it's going to be helpful. And this week's post is from Trading Composure. Okay, so I really like this post from Trading Composure. By the way, you can follow Trading Composure at Trading Composure over on X, but let's have a look and see what he says. He has great posts. Every time I see them, I always like to read because just valuable information. And so Trading Composure says small size keeps ego quiet. A quiet ego listens, adapts, and survives. Big mistakes don't come from bad analysis. They come from oversized confidence. When you trade small, errors stay small, lessons stay affordable, and longevity becomes possible. Small size equals small ego equals small mistakes. So let's unpack this a little bit. Small size keeps ego quiet. If you have a big position, you're very certain of something. Well, that's your ego, right? A quiet ego listens, adapts, and survives. Big mistakes, this is key. Big mistakes don't come from bad analysis. They come from oversized confidence. It's so true. It's not your analysis of the charts where you get hurt. It gets hurt where you have a oversized position and oversized confidence. And then what happens if something goes wrong with that trade? Now you're in trouble. Now it really hurts, and it can lead you down a rocky path. Essentially what he's saying here is trade small. If you trade small, you're going to trade the best you ever have. If you trade large, that's when ego and that's when emotions come into play. So my suggestion, especially if you're a beginning trader, start out very small. Just learn the process. Go through. If you're wrong, the loss is going to be very, very small. Trade through that process for months with a small position until you feel confident in your process. Once you feel confident in your process, then you can increase your position size and you won't have the emotional ups and downs as if you just take a big position size. So this is really key here, what he is saying. If you're having a difficult time trading, reduce your position size. It will make a world of difference. But let's read it one more time. Small size keeps ego quiet. A quiet ego listens, adapts, and survives. Big mistakes don't come from bad analysis. they come from oversized confidence. When you trade small, errors stay small, lessons stay affordable, and longevity becomes possible. These last few words, longevity becomes possible, super important. You're never going to get really good at trading and become an expert in trading unless you can do it for a long time. The only way you're going to do it for a long time is to survive. And to survive, if you trade smaller while you are learning, it will keep you in the game. Just like if you want to become a good guitar player and you break your guitar, how are you going to become a good guitar player, right? So anyway, I think this is very important what he says, but to keep your ego quiet, trade smaller, you'll trade better, and you're going to learn and you're going to survive. So thank you very much, Trading Composure. Appreciate that. All right, let's get on to the potential trades for next week. I think I've got some good ones here, some good potential setups. Now, again, these positions are not where they need to be, but they are within striking distance. So I'll be watching all of these very closely. Now, I mentioned each week that here today I have 12 potential setups for next week. It is possible that next week all 12 of these could trigger. They could even trigger on the same day. But if all 12 trigger, am I going to take all 12 positions? No, never. I have a rule. I only take one position per day. I don't care if I have 20 legitimate signals on a day. I still have to narrow it down to the best one. How do I do that? I give each chart a quality score. For instance, if it has one signal, I give it a score of 1. If it has 2 signals, I give it a score of 2. Which one am I going to take? The one with 1 or 2? Of course, with 2. Well, there's many different things that I look at here, that I use in my own trading and that I teach when I teach students, right? I look at many different things. How many signals? Was there a V1 or a V2? Was there a bullish MACD divergence? What was the risk to reward ratio? How do higher time frames factor into this? If I'm trading on the daily, I want to look at the weekly, see if I have some additional support on the weekly. What's the relative strength of the market? If the market's down, but this particular stock is up, well, that gets an extra point because it has a strong relative strength. So basically, I go through each one that's a legitimate entry. I give them a quality score, and then I have to decide which one, all in all, is the best quality score. And like I said, this is what I do every day, and this is what I teach. And speaking of teaching, I teach people all over the world, and I teach a 20-hour one-on-one course. I think to learn anything, one-on-one is the best way to go. And so I have a 20-hour course I do with my students. I do 2 hours a week for 10 weeks for a total of 20 weeks. I teach you all of my trading strategies. I teach you step by step all the rules. We do a lot of simulation trading. I throw a lot of curveballs at you to make sure. It's very important for me, really. It's extremely important for me that when I'm done with a student that I know they know how to trade and that they're going to have a skill that they can use the rest of their life. And so the course is $2,000. I know it's a lot of money, but really it's an investment in yourself. And I promise you, when you're done with this course with me, you will be a good trader. You will have the skills to become a good trader. So if you're interested, my email is in the link of the YouTube video. Just send me an email and I'll reply back. But I would love to have you as a student. Like I said, I have taught people from all over the world, from absolute beginners all the way up to the hedge fund level. And so wherever you are in your trading journey, I'm sure I can help you. And I would love to have you as a student. So send me an email. We can get the conversation started. And if you like online courses, I have a really good online course available at udemy.com. The link's in the description. In that course, I teach you the deep dip buy stock trading strategy. It's 9.5 hours of video. Really great course, has like 4.85 stars. And I've sold so many of those around the world, and it's very affordable. It's between $30 and $50, and that's a good way to start. Obviously, the one-on-one course is much more thorough and better, but it's more expensive. But that udemy.com course is really great, and it's a good place to start. So if you're interested in either one of them, The information is in the description of the YouTube video. So let's go ahead and start with the potentials for next week. Here we go. Here is Adobe. Well, let's take a look. So Adobe had a big down day on Friday, but we have created a order block here on the 20th. Why? Well, let's look at the past. Here we have a swing low. Here we have a swing high. Here we have a lower swing low. This bar here goes above the first swing high, changing the market structure to upside. So as soon as you change the market structure to the upside here, I know where the order block is. It's the lowest closing bar prior to market structure change, the high and the low of this bar here on the 20th. Boom, move that into the future. Okay, this is the key level somewhere in this order block. Now, earlier I talked about if you have, I like when there's moving averages inside the order block, but in this particular one, there is not a moving average. So I made my own from this bar here on the 21st. See this big up bar? Remember, if you have a big, strong up bar, where is that support going to be, the Fibonacci support? It's going to be at halfway of that bar. That's why I drew the line here, 318.40 at halfway of this bar. And I moved this key level, this 318.40 level, into the future. Now I have a key level, 318.40, inside a key level of a bullish order block or a smart money area. So basically what I'm looking for next week is a rejection of 318.40, meaning intraday it goes below it, closes back above it, or maybe it or maybe intraday it goes, intraday it goes below it and then closes back above it. That would be a rejection. Or maybe we close below it and then we close above it. That would also be a rejection. So really what I'm looking for on Adobe next week is a rejection of 318.40. Okay, here is BRKB. This is Berkshire Hathaway. Okay, so Berkshire Hathaway had an order block all the way back here on the 25th of August. Why? Swing low, swing high, lower swing low, market structure change. This became the order block that went into the future. Okay, now these order blocks have memories. Okay, you can see here on the 10th of December, we rejected the high of that order block. Yeah, went right on up. Did take that trade. I took plenty of BRKB trades in the past, but what I'm looking for specifically on BRKB, you see the orange line that is within the order block? Well, that orange line is the 250-day moving average. Deep dip buy signal, right? A rejection of this 250-day moving average by itself is a legitimate entry. But what I like about this trade is this 300-day moving average, not the 250. The orange line is the 300-day moving average. 200, 250, 300, all legitimate key moving averages. But this one happens to be the 300-day moving average, and this 300-day moving average is living right inside of the order block. Remember, key level within key level. So what I'm looking for on BRKB next week is some kind of bounce, close under, close back over, or intraday rejection of the 300-day moving average, which is at $488.89. And then if that happens, I will consider taking the trade. And of course, my end of bar stop will simply be a close back below that 300-day moving average. So looking for a rejection of 488.89 next week, and that would be my end of bar stop as well. Costco. Okay, so Costco, this is a little different. No order blocks, but on this one, I'm using a trend line. I'm using what's called the megaphone trend line. And a megaphone trend line is when you have a swing low, and then you have another swing low, and you connect the trend line from the first swing low to the second swing low, and you connect that out into time. And if you get to that third point, right, here's the first point, the second point, and it's extending the trend line into the future. If you get to that third line, that's generally where you will find a bounce. Well, it did go under it a little bit and then went over and went under it again, but then we broke above that trend line pretty substantially. So all in all, when you look at this megaphone trend line, once it got to that area, that essentially didn't happen the very same day, but big picture, that's kind of where it did start to head back up, and it did head back up. Well, we broke back above that trend line. Now, when you break above a trend line, everybody, very often you will go back and retest that trend line below you. You can see the trend line is below us. So what I'm looking for next week is I'm looking for a retest of that trend line. Either a bounce of the trend line, a close under, close over, or an intraday rejection of the trend line. If that happens, I will consider taking the trade. And then, of course, my emergency stop will be 2 ATRs below but my end of bar stop would simply be a close back below that trend line. So it keeps my risk to reward ratio good. But we did break above the trend line, and now it looks like we're in the process of coming back and retesting the trend line. And if that retest can hold, then maybe we get a move up. Maybe. We don't know. But it all starts with a good risk to reward ratio. If it retests the trend line and holds above, I would consider taking a trade there. Close below back the trend line would be my end of bar stop. GDX. Okay, GDX I'm looking as a short. We have created a market structure to the downside. Why? Here we have a swing high. Here we have a swing low. Here we have a higher swing high. And here we break market structure to the downside. When you break market structure to the downside, the highest up bar close prior to the market structure break will be the bearish order block. So we have the low of this order block is 89.61. The high of this order block is 91.67. So there's a few ways that I could potentially get short here on GDX. It could be a rejection of the bottom of the order block. It could be a rejection of the high of the order block. Or look at this trend line. See the trend line that we have here? See how we are now below the trend line? Now that trend line is resistance above us. And that resistance trend line runs right through the bearish order block. See what I mean? So now we have two bearish signals. We have a bearish order block, and we have a bearish trend line above us. So three options: rejection of the bottom of the order block, rejection of the top of the order block, or my favorite would be a rejection of the trend line inside the bearish order block. And that's pretty much what I'm going to look for. I'm just going to look for a rejection of that trend line, bearish trend line, inside the bearish order block. And then with a rejection of that trend line, a close back above that trend line would be my stop. Okay, so that's what I'm looking for there. IBM. So this is kind of interesting because we have two things going on here. What I'm looking for, let's start with the bullish case, okay? Here we have an order block. Swing low, swing high, lower swing low, market structure change, big wide order block. Bring the bullish order block into the future. Are there moving averages inside the order block? There sure are. There's the 100-day moving average, which is the red line. There's the 200-day moving average, which is the black line. There's the 250-day moving average, which is which is the purple line inside the order block. So a rejection of either the 100 at 282.45, or a rejection of the 200 at 269.74, or a rejection of the 250 at 263.65. Any of rejections of any of these order blocks would be legitimate and a potential entry because it's a rejection of a key level within a key level. And then depending on which major moving average it rejected, that would be my end of bar stop. But you see, I also have the red up here. It's a bearish order block. Why? Swing high, swing low, higher swing high, market structure change. You can see when the price rallied right back up to the bearish order block, what happened? That was it, and it did go down. So this is resistance. This is support. But really what I'm looking for specifically Next week is to the long side with a rejection of either the 100-day moving average at 282.45 or rejection of the 200-day moving average of 269.74 or a rejection of the 250-day moving average at 263.65 because they're key levels within a bullish order block. Coca-Cola. Okay. Coca-Cola, it's a pretty nice one. We have a swing low, we have a swing high, we have a lower swing low, we change market structure to the upside, we define the order block, we bring the order block into the future. What I'm specifically looking for on Coca-Cola is a rejection of the 250-day moving average that is inside the order block. Key level within a key level to a rejection of 68.09 is what I'm looking for. Right now we're at 69.12, so that certainly could be a possibility. I would use the 250-day as my end of bar stop. McDonald's. I talked about McDonald's last week, and I was looking for a rejection of either the 200-day moving average inside the bullish order block or a rejection of the 250-day moving average inside the bullish order block. Well, that's exactly what happened on Friday. You see how we rejected the 250-day moving average, right? We went below it and then we closed above it. So is that a legitimate entry? It is, but I didn't take the trade. Why did I not take the trade? Because we are quite far above the 250-day moving average. I don't have a very good risk to reward ratio. Now, technically, yes, you could have taken this trade right here, with your stop being the 250-day moving average. But even though it's a legitimate entry, the risk to reward ratio is really not that good. And so that's why I passed on the trade. So going forward, Monday, if we close above this 200-day, see, we closed below the 200. Had we closed above the 200, I would have taken the trade. And then I would use the 200 as my stop because it's close. But I didn't take the 250 because it's far away. So Monday, if we close above the 200-day, like a nice gentle close above the 200-day, I would consider taking that using my 200 as my new end of bar stop. Or conversely, if we go down on Monday and we reject the 250-day moving average again and the close is not very far from the 250, I would consider that. So going forward, if we have a nice gentle close above the 200, which is 303.34, then I would consider taking that because that would be a legitimate trade. Or if we go back down and we reject the 250 again with a better risk to reward ratio, and the 250 is at $300.91. But this is kind of a good teaching moment here of, yes, that was legitimate, but from a risk to reward ratio, we're kind of far away from it, and that's why I passed on the trade. So that's what I'm looking for. Close above the 200 or retest the 250 with a better risk to reward ratio. Netflix. All right. Netflix seems like it's never, ever going to go up. But listen, I have a key level that I'm looking for. I talked about this last week. We have an order block on Netflix all the way back here, January, February, March, April of 2025. We bring the order block into place. Again, let's look at the order block. Here, the order block change. We formed the order block here. Then we went straight up. Once you're up here at $134, can you look back at this order block and say, was smart money buying there? The answer is clearly yes. So this was the smart money area at one time. We're bringing the smart money area into the future. We're getting close to that old smart money area. Is it going to be smart money again? Maybe, maybe not. But more likely than not, it will be. Now, there are no moving averages inside of this order block. So I made my own. Did I just randomly do it? No. I based it upon this bar here on the 9th of April. Huge, big up bar. Remember, big, huge up bars, 50% of that big, huge up bar, you'll have inherent support. That is at $90. I bring that $90 level into the future, and now I have a key level within a key level. I have a key level within a prior key level, which is the order block. So essentially, what I'm looking for next week is a rejection of $90. If we reject $90, meaning we go below it, but then we close back above it, That would be a very good high probability trade, key level within a key level with a very good risk reward ratio. Essentially, I'm looking for a rejection of $90 next week in this order block. And if that happens and I take the trade, the $90 level will be my end of bar stop. Palantir, PLTR. Okay, this one, very interesting. It's interesting from the fact that we have an order block all the way back here, September 5th. Then we rallied from there. Was that smart money? Sure was. When we came back down to the smart money area, did we bounce? We sure did. And now we're coming back down to it again. But I like this situation better than this situation by far. Why? Because we have a 200-day moving average inside of that key level within key level. So this one's pretty easy. I'm looking for a rejection of the 200-day moving average 150-104 inside the existing bullish previous smart money order block. So essentially, I'm just looking for a rejection of 150-150 next week. It's not really that close. I don't know if it will get there. If it doesn't get there, I'll just move on to another trade. But if it does get there and reject 150-104, then I'll consider taking that trade, and the 150-104 level will be my end of our stop. Silver. All right. Well, silver has been in the news a lot. It's been all sorts of crazy. But, earlier in the podcast, I talked to you about bullish abandoned babies. Well, now we have bearish abandoned babies. We had two of them in a row. What's a bearish abandoned baby? We gap up, we gap down. That's an abandoned baby. Very quick change in sentiment to very bullish to very bearish. That's why I highlighted this bar in red. But then we have another. We gap up, and the next day we gap down. So we have two bearish abandoned babies at the same time. Now, if you have a bearish abandoned baby, the bottom of that baby is a key resistance level. Well, the bottom of that baby right now is $68. We're at $65.78. So what I'm looking for next week is if silver rallies back up and rejects that $68 level, then if I take the trade, remember on babies, I do this a little different. I would go short with a 4 ATR profit target to the downside and a 2 ATR stop above. Okay, so two bearish babies in a row. If we reject the bottom of the most recent baby at $68, I will consider taking the trade, get short, 2 ATR stop, 4 ATR profit target. Tesla. All right, so Tesla has sold off for the last couple weeks. We have a nice order block down here that formed 1121. The high of that order block is 402.80. The low is 383.76. Once that order block formed, took right off. Was it smart money? Clearly, when it was up here near $500, this was smart money. Is it going to be smart money again? I don't know. More likely than not, but I don't know for sure. Now, I drew a key line here, 393. Why? Greg, I don't see a big up bar over here. That's true, but what we have is a V2. V2s, V1s, big part of my trading and my courses that I teach and in my trading are V1s and V2s. A V2 consists of 3 bars, bar 1, bar 2, bar 3. Bar 2 has to go under the low of bar 1's low. Bar 3 has to close above the high of bar 1's close. That is a V2. Was it bullish? Yeah, it was. But the thing about V2s is that the second bar of a V2, halfway of that second bar, there is inherent support, 393. It's halfway of the V2 bar, or it's halfway of the second bar of the V2. Halfway there, 393. So that is my level. By the way, if you want to learn more about V1s, V2s, just go to my YouTube channel. I have a lesson there on V1s and V2s, and it will explain in detail. Okay, so that's what I'm looking for. That's the level, 393. Key level, halfway of the V2 bar, inside an existing smart money order block area. If it gets there, great, I'll consider it. If not, I'll just go on to something else, but that's what I'm looking for on Tesla, that's the key level for me, 393, rejection of 393. If it rejects it and I take the trade, 393 would be my stop, end of bar stop. Last one, XLU. XLU is utilities. Kind of boring, but there's a nice setup here. We have an order block all the way back here from the 8th of September, all the way back here. Okay, we had a swing low, we had a swing high, we had a lower swing low, we changed market structure. When we were way up here, we look back here, was that smart money? Yeah, for sure. Well, that smart money area, we are getting close to that smart money area again. Will it be smart money this time? I don't know, but more likely it will. But what I like about this is that we have a key level within a key level. We have a 250-day moving average, which is the purple line inside the bullish smart money area. Okay, 41.44. Right now we're at 43.18. So we're not there yet. We may never get there. But if we do, that is the level that I will key off of, 41.44. If it rejects that and I take the trade, then the 41.44 will be my end of bar stop. So there you go, everybody. Those are the 12 that I'm looking for. Hope you found this podcast helpful. If you did, I'd appreciate if you could hit the thumbs up button. If you have any comments or questions about anything I mentioned in the podcast today, put them in the comment section. I'll do my best to get right back to you. And if you've made it this far in the podcast, thank you very much. I hope you found it helpful. You know, I always like to leave off with, if you could try to do one nice thing for another human being each day. If we all did that around the world, man, the world would be such a better place. And so I always try to suggest, try to do one nice thing for another human being each day. It will come back around to you. Really, it will. And, I'm a big animal lover. And, if you could try to do one nice thing for an animal each day, even if it's the smallest little act of kindness, they appreciate acts of kindness just like we do. And just make the world a better place. But, if I can help you with your trading, I'd love to have you as a student. Please reach out to me, send me an email, and get right back to you. And I'll teach you everything I know. But I hope you enjoy the rest of your weekend. Have a good trading week next week. Follow your rules. And again, thanks so much for being here. And God willing, I will talk to you next week. Thanks a lot, everyone. Take care. Bye-bye.
U.S. government required stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.